Good evening. My name's Jeff Quartermaine, and I'm the CEO and Managing Director of an Australian mining company, Perseus Mining Limited. We are a gold mining company, gold mining exploration and development company. Our activities are focused on the African continent, where we have 3 successful operating mines and several development projects. We're currently producing around 500,000 ounces of gold a year, and we're doing it at an all-in site cost of about $1,200 an ounce, which in the current gold price environment clearly generates material margins and significant quantities of cash.
Jeff, good to see you. So, right, quarterly results out, and also decision to go ahead with Nzaga as well. I'll start with the quarterlies, if I may. I guess the number that stands out is, cash and bullion now standing at around $800 million US dollars. That's a tidy sum. What are you going to do with it?
That's an excellent question, and it's one that is exercising a lot of people's minds. I might say that sum of money has been accumulated, notwithstanding the fact that we've paid high dividends during the course of the quarter, and we've also been busily engaged in a share buyback. So it is quite a credible performance. But let's be very frank. I mean, the gold price has certainly been a major contributor to that, and we acknowledge that. Although having said that, we are producing across the board at an all-in site cost of $1,209 an ounce, which means that in global terms we would be towards the bottom end of the cost curve, and in the current gold price environment our cash margin is well over 100%. So yes, it is a very tidy sum of money, and I should also say that we have an undrawn line of credit of $300 million US dollars. So combining those two sums, we do have the capacity to invest significantly further, but we also have the capacity to manage that capital and return significant amounts to our shareholders as we go forward.
Right, and obviously with you said about 76% of your production exposed to spot price. Are you revising or thinking about revising your hedging strategy for financial year 26?
Well, we have actually revised our hedging strategy to the extent that rather than using spot deferreds, which has been the preferred method of hedging in the past, or spot deferreds rolling forward into designated hedges, what we have been doing in recent times is using zero cost collars. So we have a floor of about $2,600 an ounce, but a call option sitting at well over $3,000 an ounce. So we are getting the benefit of the gold price between 2,600 and 3,000 odd. So it's not like we're losing all upside here. We think that the zero cost collar option is one where we can have the best of both worlds. We can have downside protection, but participate in the upside to a degree as well.
Okay, and you've maintained full year guidance, despite the costs at Sisingwe rising, and obviously some land access delays at Edikan. What's giving you that confidence?
Oh, look, I mean, our costs are, we're in reasonably good shape. I mean, I think the guidance that we've given to the market for the half year is something like 1360 to 1435. So we're currently tracking, quite a significant way below the bottom end of that range. Now, some people would say, look, you're overly conservative, and to some degree that is true, that we have been expecting, higher levels of inflation than we've actually seen. But we also run the business reasonably tightly. Now, going into the future, though, I think it's going to be increasingly difficult to keep our costs where they are, particularly if the gold price keeps rising, because we are paying some fairly heavy amounts of royalty to the governments in our host countries, and embedded in that all-in site cost is quite a substantial sum of money in the royalty area. The other thing that's going to be changing over a period of time with us is that we will be starting an underground mine at the Yaouré property fairly shortly, and associated to that is, with that underground operation, is costs that are a little higher than what we're currently seeing on the open pits.
Okay, and can I just I want to touch upon each of the kind of key projects, and if I can start with Yaouré initially. We've seen a sort of kind of positive variance in terms of tonnage up, but grade slightly down. what actions are you taking to kind of improve kind of grade predictability and overall kind of reconciliation performance?
Yeah, look, with Yaouré, that has been a bit of an issue in the last quarter, I have to say. Well, actually, probably the last couple of quarters. It's associated with two things. One is that as we're going down on the CMA pit, we are in the fringes of the ore body, so it gets at the outer edges of ore bodies, it gets a bit ragged. But the other thing is that we've just opened up the Yaouré open pit as well, and it's anyone who knows that pit is the geology in there is actually very, very complicated, and so the grade control methods that we had been previously using very successfully in CMA need to be modified to give us a better outcome in that Yaouré pit. So we are doing a lot of work on that at the present time to try and improve our predictability. I mean, at the moment we've got a situation where I can't remember the exact numbers, but we're about 30% positive in terms of tons, I think it is, and 20 something or other percent negative in terms of grade, but all up contained gold is quite significantly higher than what we were predicting. But there is that variation, and it may well just simply be a function of where we are in the ore body, and over time things will settle down, because certainly at Yaouré itself, on the CMA pit, the reconciliation over the life of the project's been actually very good. But you do get these short-term fluctuations, and what we need to do is to make sure that that we understand what's causing that, and that we can make appropriate accommodations in our planning as we go forward. So there's no real surprises there.
Yeah, no, like, and that's not to say that the margins aren't excellent. In fact, they're probably record margins at the moment on that. But what's the kind of process of and time frame to understand the impact of like with the underground at CMA, the impact of mill feed blend, mining costs, overall production profile, etc.
Oh well, look, in terms of the metallurgy, we've actually run tests to make sure that there is no variation in that CMA deposit. I mean, we were mining that same ore body open pit for the last 4 years, so we understand the metallurgy pretty well. So that's not an issue. But certainly as we start the underground mining, I mean, we're going to be cutting the first portals in July, and we we'll be on mineralisation straight away, but we won't be declaring commercial production until I think it's about 18 months, I think it is, later on. Now, so there will be some progressive increase in the reported all-in site costs. Certainly once we've reached commercial production, the cost of underground mining is more expensive than open pit. That's a known fact. But look, at all of this this numbers have been put into the public arena in a release that we made. I think it was 25th of January this year, I think it was, where we itemised precisely what the state of play was. So I think the market's aware of the cost structure.
Right. Okay. And so obviously you're going through a kind of process of trying to work out how the underground and pit and surface mining kind of blend together, make sure they kind of throughput at the mill.
No, absolutely. So what we won't be getting full mill feed from the underground. We need an open pit operation to be able to keep the mill full, very definitely. And we've worked that out fairly well we think to make that happen. And we do have this new pit, the Yaouré pit, which will provide open pit material. And then there's a couple of extensions on that. I think it's Zone 1 and Zone 2, which are off to the edge of that. So there is certainly open pitable material, quite a lot of it there, which we will blend with the underground, and we can see a mine life at least a dozen years ahead of us now, without any further discoveries on the property. So Yaouré is going to be with us for quite some time to come, I can assure you. Bear in mind that we started first gold production in 2020, December 2020. We're now looking at quite a lengthy mine life for that Yaouré project, which in fact is what we predicted when we set out. We started off with a smaller proven reserve, but we did say to people that we thought that there was potential to extend the life, and that's what we've proven in the last few months.
Okay, and let's jump over to Edikan. Obviously, you've had some sort of access delays in Q2, which has impacted performance around in terms of production, but also a little bit on margin. But there are other things too on top of that, which in terms of the kind of the Incursio ramp up and the Fetish pit wind down, etc. When does that start to sort of take shape again and regain form?
Well, I think it should be back on track. Hopefully later this quarter, we would like to think. I mean, what the issue is that as you say, Fetish and AG are coming to the end of their life. In fact, the Fetish pit, we finished that a couple of weeks ago. And while we were doing that, we were looking to be ramping up on Nkosuo. Now, the access to Nkosuo has not been what we were hoping to have. So, in fact, we haven't been mining in the exact sequence that we had originally planned, and we've been taking material that is a little lower grade than we would have liked to have done at this particular point. But look, we are making progress, we believe, with the farmers who have been holding out. I think it's been an interesting exercise actually in gaining that access. It hasn't been helped by the fact that a couple of factors. One is that the cocoa prices have been very, very high, and so farmers are a little reluctant to let go of land that they've been farming, and we understand that, and we're paying elevated compensation rates that reflect those high cocoa prices. I should mention the other thing that does impact in this area is galamsey, is artisanal mining, and a number of these farmers have been taking money from artisanal miners over time, allowing them to work on their property. And of course, with that, if that arrangement comes to an end, that's a little bit awkward. So there are a number of factors that have been impacting on our ability to close out that access issue. But we are confident that we're getting close to it, and we do have I should say, and this is a very important point, we do have the full access of the Ghanaian government, who have confirmed to us that we have approached this whole matter in absolutely the correct manner. We've complied with the law at every step of the way. And, they are very, very supportive of what we're doing, because not only do we, pay taxes to the government, but we also put a lot of money into the community, and we employ a lot of people. And the net benefit of Perseus's activities in Ghana is quite significant. So, I think we do have generally strong support from our key stakeholders, and we hope to be able to finalise those matters pretty shortly.
Okay, and with regards to decision on the cutback at Fetish, I mean, what does that affect in terms of the Ghanaian portfolio, and what's it do for the rest of the company?
We've actually been doing a little bit of work on Edikan and Sissingi, I might add as well, to see if we are in a position to extend the life of these projects. Because bear in mind that a number of the pits that we have been mining were originally designed based on gold prices that are very much lower than what we're looking at today. So, $1,200-$1,300 an ounce pit shells. Now, the thing is this, that, it's a very easy thing then to go and design a pit using, say, a $1,700 pit shell. But what it means is that the incremental ounce that you get from that shell comes at a cost of $1,700 an ounce. So you're trading production for cost. And the question of is that the right thing to do in terms of generating benefits for your shareholders? Now, if the gold price was to stay strong for a lengthy period of time, then the answer is arguably yes. But if you are concerned at all about the gold price or any other risk factors for that matter that might interrupt the operation, then you probably be a little less bullish about it. But we're going through that process at the moment, and we can see that on both Edikan and Sissingi, there is ample opportunity for us to extend the life of those projects well beyond the current projected mine life. And, some of the people in the market who think that both of those projects are nearing the end of their life may be a little bit surprised by, where we come out with that in the next few months.
Okay, and what's the time frame of that? Because there's a kind of potential short-term recovery as Fimbiasso and the Sissingi Stage 4 become accessible. So what are we looking at in terms of it kind of improving?
Well, look, what it'll do is it'll give us extended mine life. Basically, it's not going to change anything in the short term, but it will extend the mine life basically. So what we have coming up in the short term is what it is, and we're working through our budgets at the present time, and we've got a pretty fair idea of what's going to be happening, and we'll be presenting all of that to the market in due course. I'm very hopeful that in the latter part of this current quarter, we will be able to share with the market our guidance for fiscal 26, and at the same time give the market a very clear understanding of what is going to be happening over the next 5 years at Perseus, where we, bring on stream the CMA underground, we bring on stream the Nyanzaga project, and possibly, extend the lives of the other assets, and anything else that happens in the meantime. There's lots of possibilities. Of course, when you're well funded as we are, we're in a very good position to look at other alternatives.
Okay. Well, I'll move away from Sissingué because I know time is short with us today. It might be worth sort of talking about jumping over to Nyanzaga, because that's the new kid on the block, and you have made a final investment decision on that. So you said a year ago you would advance things, and here we are a year later. You've decided to go ahead. It must have been quite the process to go through, but you've done what you said. How did the government feel about that?
Well, I think the government is delighted, actually, and I've got to say that we've worked very carefully with the government from day one, and have forged strong relationships. And I think that what we've sought to do along the way is to ensure that all of the stakeholders get their fair share of the benefits of this project. And I have to, give a shout out to my team, led very ably by our CFO Leanne Brun, who has been working tirelessly with the Tanzanian government, and has been able to establish a situation where, we have been able to work our way through some challenging issues, but we are at that position now where we've reached agreement on all of those, and we're awaiting final sign-off of the Attorney General, and we expect that that'll happen in the next week or so. And hopefully, actually, when we visit Tanzania in about a week or two's time, hopefully we'll have a signing ceremony on the site where, some of the people that have been involved in the project from a distance can come and actually see what is happening on the ground, and I'm sure they're going to be pretty excited by it all.
Okay, so obviously it's a big decision. The numbers don't seem too different from, I guess, what you bought into from the ore group. It's still a sort of inflationary accretive market at the moment. Were you sort of pleasantly surprised, or had you done the homework before you bought it?
Oh, look, we did a lot of work before we bought it. There's no doubt about that, and we had a very different view of the asset to what the previous owners were telling the market. And so, we haven't been surprised by what we found. We were surprised by a few things, I must admit, along the way. Would have been nice to have understood those, but the issue is this: that what we have been doing is drilling out the ore body, doing confirmatory drilling from converting resource to mineral, inferred resource to measured and indicated and the like, but also be doing geotechnical and metallurgical work as well to make sure that we've got the right view around metallurgy, around pit slopes, etc., etc. So the project that we've announced to the market on Monday is the first phase of the exercise, and we'll recover a little bit of over 2 million ounces from that first phase. The way we're going about the project is quite different to the previous owners. They were contemplating a small open pit at the top of the ore body, and then using funds from that to finance a development drive, and then to mine underground below that. What we are doing is doing a very large open pit, a much larger open pit, and we're building a 5 million tonne per annum facility, and we will be putting all of that material through. This is a better utilisation of the natural resource, I might add, as well. And the thing is that this first phase delivers the 2 odd million ounces recovered, but we're embarked on the second phase of drilling as we speak, and by the end of this year we'll be have a lot more drilled data, and I have every expectation that before we start producing first gold from this mine in January 27, that we will be upgrading the reserve for this project and be demonstrating an extension of the mine life in the open pit. Now, I might also add that we've also been getting doing some deeper drilling and getting a few intercepts at depth that certainly give us cause for confidence that, in fact, with a more concerted, deeper drilling program, there may well be sufficient mineralisation there to support a very, very lucrative underground mining operation. But we're a long way from that at this particular juncture. We've certainly had the encouragement, but we really need to do more work, and that's probably the third phase of the project, if you will. But certainly the first phase, everything we expected it to be, and then some. The second phase is going to add a lot of cream to the sideboard, and if there's a third phase, then happy days.
Well, let's talk about that, because I think there's a kind of valuation discussion that needs to be had about Perseus relative to others, and I say that in the context of there's a lot of M&A been happening with out there, not just to kind of get resource numbers up, but also to kind of replace and back up reserve numbers out there, because that's what the institutional boys and girls like to see. So how do you view Nzaga? Is this a defense move, given what you're the sort of work that you're sort of doing at Edikan and Sisingwe, or is this a growth story?
Well, it's a bit of both, actually. I mean, it does certainly provide growth over and above what we've been doing, in recent times for a short period of time. But inevitably, if the other projects come to an end, then their contribution disappears, and without addition of other projects into the thing, then you could potentially see a fall off. But I can say very comfortably and confidently that we will be producing in our targeted range of 500,000 to 600,000 ounces a year, well beyond the end of this decade. So, that's something that we'll demonstrate to the market fairly shortly. But the thing is that we haven't exactly got a track record of sitting still and sitting on our hands. If you look at what we have done from an inorganic perspective over the last 7 or 8 years, we've actually acquired 4 companies. One first of that was Amara, where we got the Yaouré project, the Exor project, where we got ground at Bagway and in that general area to supplement Sissingué. Orca, which gave us the Maya Sand project, which I'll come back to, which is arguably one of the better assets in our portfolio, albeit it's not being developed in the immediate future due to the political situation in Sudan, and of course Orca, actually, I beg your pardon, the Nyanzaga project. So the thing is that we have financial capability, we have proven capacity to transact, we have proven ability to spot value in the marketplace and do what we need to do. So I don't think, people could say, oh, well, Perseus is, going to run out of reserves in 10 years' time. Well, yeah, we sure will if we sit there and do nothing. But the chances of that happening are pretty remote, let me assure you.
Okay, let's talk about Suzanne very, very briefly, because I think, as you say, it's probably one of the better projects you've got, but it's obviously not moving forward. Geopolitical situation in Sudan. Do you think people are giving you zero value for that? And if so, do you think they're also marking you down elsewhere as a result? Should they? I mean, how do you think people should view you?
I think they are giving us. I think they are giving us zero value, and that's fair enough at the moment because we don't have a horizon for monetising that resource. So that I think.
But are you allocating a lot of capital and time and effort to that? Is that why?
Not a lot of. No, I mean, there's clearly holding costs where we're doing a bit of exploration and things like that, but it's not improportionate, that's for certain. And so we think that investment in that holding is money well spent. And at the same time, what we are actually doing is looking at, are there alternative development strategies for this asset where we can actually get it going, perhaps on a different scale to what we originally envisaged in order to get things moving along. I mean, that's a very viable proposition. If you look at our experience into Côte d'Ivoire, there is a bit of a learning that is worthwhile considering. When we went to in Côte d'Ivoire, we had 2 projects. One was the Sissingué project up in the north of the country, and the other was the Yaouré project that we'd acquired from Amara. Now, our first exercise in Côte d'Ivoire was to develop the Sissingué project, which was a relatively small investment, producing around 70,000 to 80,000 ounces of gold a year. By doing that, we learned how to operate in a new country, in Côte d'Ivoire. We established our credibility with the government and the community. And the cash flow from that small development paid for the development of the larger Yaouré project in years to come. Now maybe, and we're saying, well, maybe there's an opportunity to follow a similar pattern in the Sudan, where we start something small and maybe use the funds that are generated to finance a bigger development in time. So these are all things that we think about, and we we're looking at it all from different angles, and we'd like to think that before too much longer we can add some value to that investment that we have. We have already extracted some value, I should add, because you might recall that when we bought Orca, we also bought a 30% stake in Montage. And Montage has done exceptionally well in the market in recent times, and we were able to take, to sell our stake in Montage and translate that into a 20% interest in Predictive and the Bankan project. So we already have taken some money off the table in terms of our investment in Orca, but there's still a lot more value to be had, and it may take a little bit longer than we had originally envisaged, but I can assure you that we're not short of ideas on how to make it work.
Okay. So lots of optionality there. And I think a lot of companies are seeing rewards for being able to tell a near-term revenue story by just changing the kind of CapEx profile of companies. It'll be interesting to see where you end up deciding to go with that one. And just again, sticking with Nzaga, I think to remind people, we've got peak production of about 245,000 ounces and an average AISC of about 1,200. It's clearly a big contributor to the bottom line at the moment, but it's also, I guess, globally significant project, isn't it?
Well, it's not contributing anything at the bottom line at the moment, I might add. It'll be a cash outflow for a couple of years, but no, look, when it gets going, it'll certainly make a material contribution to us. And you're right. If we can do it, what I'm saying we think we can do, and that is add a second phase to this project through the drill out that we're doing at the present time, then I think there's every possibility that this will be a world-class project. And that people will look back on it and say, gee, we had the opportunity to get that many times over in the past. We missed out. So anyway, we're hoping that that's the case.
Okay. Just a few little technical questions we've been sent in, which is around the kind of structural complexity or not of Nzaga. And the anticline, I think. Its impact on mine sequencing, dilution, and scheduling. What can you tell us about how you get after this?
Well, look, there's nothing terribly unique about it. There is a bit of a cap on top of the ore body, so we've got to take the top off a hill, and that mining is going to start very early on in the piece. In fact, I think in the schedule we're currently programmed to start mining in about June next year, June 26. However, if we can start earlier than that, if we can start actually in January, February next year, then we will be able to improve the amount of production we produce in 2027 over and above what we're currently looking at, because in those early months of production, the mill is actually ore reserve constrained rather than being capacity constrained in the mill. So by starting the mining earlier, we will have access to more ore to feed into the mill and be able to produce earlier. So that's something that we're looking at the present time. Of course, what are we now in April, early May? We're getting a full-blown mining contract in place and having somebody in position, in the next 6 or 7 months is no small feat. But it is something that we're going to have to do, because it's not only about getting a contractor, but we've also got to be able to house people on the site and have them, give them work spaces, etc., while at the same time we're building a fairly substantial processing facility. So it's going to be a very busy site over the next 12 to 18 months, I can assure you.
And how similar is it to what you're doing elsewhere with the other projects? The gold is kind of hosted in the breccia and quartz veins, so there's a kind of potential for variable grade distribution vertically and laterally. So have you seen that elsewhere with your other projects? Have you got the skill sets in-house to deal with it?
I absolutely got skill sets. Our guys are all over this stuff. And have a very good handle on it. I'm not in the slightest bit concerned about that aspect of it. And look, they're all different. No two ore bodies are the same, and no projects are the same. The whole approach to things. This is a very different approach to, say, Yaouré, where we had an extended period of time developing, and then we move, into an operating phase. In this particular instance, we're going to be moving into that operating phase much sooner than we might have otherwise done elsewhere, and that brings its own sets of pressures as well. I think also too, Tanzania as a country is very different to Cote d'Ivoire and Ghana. They have their own approach to local, sourcing of goods and services. So, right from the get-go, we need to be on the game to make sure that we comply with all the laws of the country, and that we do the right thing by the Tanzanians.
Okay. And just one question was sent in was around the kind of selective mining unit approach to this. I mean, is that because you can expect sort of dilution and ore loss trending needs control, needs monitoring in the kind of early years until you understand it better?
No, look, that's not the subject that we've been discussing particularly. I mean, I'm not sure where you're coming from on that particular one, but no, look, I think what we're doing doesn't phase us in the slightest. This is the fourth project that we will have constructed and operated. So and we've got a lot of people in our group who are very, very capable and competent people, I might say, as has been demonstrated by the results that we've turned out over the last 10 years. They speak for themselves. We don't have to speak for us. The results speak for themselves.
Okay. So I know you did talk about the MET work. Can you just give us a little bit more detail on some of the work that you're carrying out at the moment?
Well, look, acid rock drainage in this part of the world is something that we haven't encountered before, and so we want to make sure we understand that aspect of things very well. We also need to obviously make sure that our recoveries are going to be what we think we are. But the one area that we do see some terrific opportunity is in the geotechnical side of things. Like, given the size of this pit, this is a pretty big pit. It's about 500 metres deep. Now, if you can change your wall angle by half a degree, that can change the stripping quite materially both ways. If you lay it back or you steepen the walls, you can get a very, very different outcome in terms of the economic process. So it is very definitely worth our while to make sure that we have a very full knowledge on the geotechnical side of things, so that we can get that side of things correct. Now, we do have the opportunity that, there are various phases in the pit, so we do have the opportunity. We don't need to know the right answer on day one, but we obviously do need to get to know that answer pretty shortly into the process.
Right, and again, just to remind folks, in terms of the kind of the gravity circuit or alternative leach technologies or regrind circuits or whatever the options may be, what are the conversations at the moment? Where are we reached?
Well, look, this is a fairly bog standard plant actually. It's got grinding, SAG ball mill, et cetera, and this. We're working with our friends at Lycopodium, who have done these things all over Africa and done them exceptionally well for us in the past. So there is nothing particularly new here that hasn't been done in probably 4 or 5 or 6 other mining operations across the continent. And so we've got a very high level of confidence that what will result from the work that Lyco and our team have been doing will deliver some pretty decent outcomes. Now, somebody said to us yesterday, look, we think that your costs look a little bit light relative to other construction. Well, there's a very good reason for that, and the very good reason is that Perseus undertakes a lot of work itself. So Lyco do the plant, and we do pretty much everything else, and that's an internal team of people. So buildings, roads, etc. A lot of that work is done by our people, and so in that way we're able to, we're not paying a margin to contractors, etc., which is one of the reasons why we are able to keep the costs, into a reasonable level in the current environment. But Lyco themselves, as the engineer and builder of the plant, I mean, most of the large-scale projects that have been done in the African continent over the last 10 years, including with clients like Newmont and Barrick and the like, I mean, and Endeavour particularly, and Perseus, dare I say it, have all come from the drawing boards of Lycopodium, and they're a very, very experienced group of people, and we work very well with them.
Right. So you talked about the kind of relative simplicity around of the kind of the metallurgy and the operation as such. Do you feel the same way when it comes to the work that you've done on the process plant? Performance, potential performance, operational flexibility, etc. When you're trying to manage things like.
No, look, we are very comfortable with this, and the reason of this is that we've learned an awful lot of lessons over the last 10 years, I can assure you. I sort of say somewhat flippantly, after Edikan we had 12 volumes of what not to do, and what we should be doing. After Edikan and after Sissingué we added another volume or two, and after Yaouré we added some more. So one of the key events that we have done in the last 6 months is sit down with our operating teams who have been operating these plants and saying, look, what are the things that we need to look out for in the design of this particular plant? Let's make sure that we can actually build it into the original build rather than having to retrofit later on, because that is another way of keeping your costs in check as well. I mean, retrofitting is quite an expensive exercise. So we have learned a lot of lessons. We had a big session over at Yaouré. I think they held the event where the operators and the builders all sat down and had a very in-depth conversation around the successes and failures or pros and cons of the previous designs, and we picked up a lot of lessons off the back of that.
Yeah, no, I mean I chose the word flexible, the operational flexibility deliberately, because there's a sort of dynamic decision making on everything that you do in terms of like calibrating, throughput rates, things like that matter, I guess.
Yeah, no, it does. Look, I'd say to the guy, we're in a very different position today than what we were, say, when we built the Sissingué mine, in the sense that we do have the financial capability to spend a little bit more if it makes sense. So when we did our earlier builds, we didn't have a lot of cash, so we had to, live on the smell of an oily rag, so to speak. But now we can look at a situation and say, look, okay, we can do this or we can do that. Does doing it this particular way generate a better outcome in terms of operability? And if it does, if we can demonstrate that doing that versus that is going to generate a superior return, then we do the other thing, even if it does cost a little bit more now, because we've learned that, spending a little bit of money during the development phase quite often pays very, very big bonuses down the track. And the flip side of that applies too. Cutting corners in the development phase can create some real operating headaches later on. And, I'd be perfectly honest in saying that, all of our properties have got some nuances that, if we had our time again, we might have done a few things differently.
2020 hindsight, isn't it? That's great to talk about. All that kind of risk management. I mean, if we I wouldn't mind getting your thoughts and expanding on some of those things you just said with regards to that execution risk and mitigation of risk. At the earlier stage. Now you've got your own team, but obviously you'll be buying in services as well. So how do you kind of stop that kind of cost creep or kind of scope drift activity from your own team and bought in, right?
You clearly haven't been sitting in our meetings of late, have you? But no, we are putting in place very, very stringent controls from day one. And we have very clear processes that need to be followed in order to be able to invest in certain aspects of the job. We know precisely what we're going to be doing, and there are very good control mechanisms in place. And, if there is a cost blowout, I'll be pretty surprised. But we'll know about it early, that's for sure.
Okay. Well, I'm so conscious that you are abroad and you've got people waiting for you. But maybe we can sort of come back on scene and we can maybe get into the weeds a little bit around this operational component around Nzaga, because it is super result for you guys and quite impressive numbers. So we shall see you soon, sir, and we'll let you get on with your day. Thank you very much.
Very good. Well, thank you very much once again for hosting me and having this conversation. And we'd like to renew it. We're actually heading to Tanzania this weekend, in fact, with our full board, and they will see, what it is that we've been banging on about for the last 12 months. So after that visit, I'm sure we'll have lots more to tell.